Hello everybody, it's Tom Sheridan and Chris Darbyshire from 7IM. We're here today as a special one-off or ad hoc production. We normally do the forecast of what's going on in the world and what do we think about it and how to react to it in the portfolios on a quarterly basis. And lo and behold, 2014, January, we wake up to emerging market hysteria. It's all over the press. What are you guys thinking? What's going on? What should I do? Are the questions that we've been getting. So we thought that we would just do a very quick little communication, tell you what it is that we're thinking and what it is that we're going to do about it. Last year's headlines, Chris, we saw several times, we saw the Eurozone was going to collapse, and then it didn't collapse. We saw, oh my God, Angela has to get reelected, otherwise it's all going to fall to pieces. Didn't fall to pieces. U.S. was going to default. They didn't default. Are we here again?
I thought those were genuinely quite rational, significant concerns. I think the press overplayed them. Probability of them resulting in a bad scenario was really quite low. This time, I think it's even less than that. I don't think we really have strong concerns out there to worry about. The macro environment is looking very good, and the data since the beginning of the year has been very positive indeed.
Well, if you look at what has happened in markets, equities in emerging markets and indeed developed markets have fallen. Emerging market currencies have fallen. Emerging market interest rates are going up. So clearly somebody's worried about something. What are they worried about?
Well, so I think this is a hangover from the fear of tapering and what it might do to emerging market currencies and growth. So middle of last year we had the initial reaction to tapering, which was among emerging markets. It was a very bad reaction. And the fear is that we get into a situation where tapering causes a run on emerging market currencies because investors think the dollar is going to strengthen and therefore emerging market currencies will weaken.
So taper gets interpreted as higher U.S. rates, which attracts money out of emerging markets.
Exactly.
Okay.
Attracts money back to the dollar. And it's often the case that emerging markets are the speculator's favourite haven when he's shorting the dollar, when he thinks the dollar's going to go down.
Right.
So as that reverses, money flows back from emerging markets, their currencies begin to weaken. That then leads into a vicious circle where if your currency weakens sufficiently, the things you import cost a lot more, so your inflation begins to tick up.
Right.
Now your inflation's ticking up, the central bank now has to increase interest rates to make your currency more attractive, to bring the money back.
Right.
Strengthen the currency again, and that tends to slow the economy, so you're into a period of slow economic growth. So you get into this vicious circle of bad events causing other bad events.
So that's what the market is really worried about right now.
That's the bad scenario that's potentially out there if you get a significant enough run on EM currencies.
So what does it matter?
It matters because the size of the current account relative to the size of the country's economy determines the amount of currency flowing in or out.
And is that where the foreign exchange reserves become important?
Exactly. If you have large foreign exchange reserves, then you're able to cope with an outflow of currency. In fact, if you have large foreign exchange reserves, when your currency depreciates, your foreign exchange reserves go up in value and become more defensive. So you become better able to cope with your own currency's depreciation.
Okay. We now know what the market's worried about, and we probably ought to take a look at how real do we think those fears are. The first thing that we might do is to take a look at, so what are the emerging markets? And as you can see on the slide, China, Korea, Taiwan, Brazil, it's about half of the equity index. So they become the most important of the countries. And of those most important, the top of the list, of course, is China. Let's talk about China a little bit. What's going on there?
So in China we have investor fears that the problem of bad debt, so debts loaned by local banks to companies in China that have been spent on unwise projects, so cities, empty cities in the middle of nowhere, power stations with no demand. There's a worry that those bad debts are significant enough to cause upheaval in the Chinese economy and therefore put a big dent in economic growth there.
And how real are those concerns?
Difficult to estimate. China's always a difficult market to know if the data is good. But those concerns are significant, we think, but they're no more significant than they were maybe a year ago or even before that. In other words, we would argue that the hard landing that people worry about with China is no closer to materializing than it was, say, a year ago or 18 months ago.
So the new government in China has been in less than a year?
Correct. And they put out an important document, policy document, towards the end of last year, which attempts to address some of the imbalances in China. And market reaction to that document has been somewhat divided. Some investors have been very positive about the document and that it stimulates innovation in new parts of the economy where innovation is needed. And some have been disappointed in the sense that it doesn't address these perceived problems head on.
So an optimist would say, isn't it a good thing that the new government is saying, yeah, we do have some problems and we're trying to get our head around them. And by the way, growth has not fallen off a cliff. Growth is still 7-ish%?
Growth is 7-ish%. We don't really believe the headline growth numbers. Secondary growth indicators are slowing and have been slowing for a couple of years. But I think what we see is part of the economy very dynamic. So car sales in China are up 13% last year, petrol usage up 9% last year, and then parts of the economy do have the bad debt problem. It's not a universally negative picture.
So part of the China and emerging markets story is as China slows, question, are they slowing? Then they're going to consume less in the way of commodities. A lot of the emerging market countries are commodity exporters, and they are going to feel the impact of all this. Oh my God. What do you think of all that?
I can see it's a rational concern. I just don't see it in the numbers. I do not see emerging market countries suffering because their commodity exports to China are slowing. We look for the data to confirm this and really do not see a lot.
Okay, so our view is even though growth is slowing in China, it's not fallen off a cliff, and it's a 7% increase on a bigger base, which means still more commodity consumption, not less, just maybe not at the same pace.
I think it's a very important point that commodity consumption is still going up.
Okay. We've seen unbelievable headlines about Argentina and Turkey and graphic explanations as to why this is going to cause the end of the world.
The situation in Argentina has been bad for 10, 20 years. We have no exposure to Argentina in our portfolios. The emerging markets do not include Argentina at all. Turkey, on the other hand, yes, there is significant political uncertainty there. But again, Turkey is a relatively small part of for example, our equity exposure only has 1.5% of our emerging market exposure is in Turkey. So these are very small and barely significant markets.
So if, from an investment standpoint, if Argentina and Turkey are not very relevant, particularly if you're holding 7IM portfolios, then Contagion becomes the potential risk for little countries like that.
Yes, I think it's contagion spreading from those countries to the bigger countries that is our risk.
And what's your assessment of that risk?
There's very low probability that you're going to get anything more than a temporary run on the currencies, because the fundamentals of emerging markets, the foreign exchange reserves are so substantial today. The makeup of emerging markets is so different than it was back in the 97-98 Asian currency crisis. All these things suggest, and we look at the earnings flowing from emerging markets, and they are very solid. They're no more volatile than the earnings flowing from Europe or Japan. So we have a picture today Don't forget, emerging markets are 50% of world GDP today.
Yeah, and that's probably one of the basic differences between what we may be looking at now and what we might have looked at in the past. The last 100 years have been littered with emerging market panics. Are we now going to be subject to contagion becomes panic in the emerging world, which because it's 50% of global GDP now turns the developed world on its ear? And is that the scenario everybody's worried about? And what do you think of it?
Very, very hard to buy into that scenario because the developed world is still the leader. The US is still the leading economy, and all the fundamental data in the developed world is beginning to point in the right direction.
Well, that's what's caught my eye over the last week, 2 weeks, month or so, is that the economic data, which comes through maybe on page 4 or 5 or 6, not maybe on page 1, actually pretty good.
Very good indeed, actually, and I think the world is a better place even today than it was a month ago.
So we have to distinguish between markets and economics.
That's a very good point, because although emerging markets have grabbed the headlines, the sell-off we've seen has actually been more about Japan than it has about emerging markets, where people are concerned about a consumption tax coming in the spring. It's also as much about developed markets as it is about emerging markets. Europe has been hit, the US stock market has been hit. This is more a general nervousness among investors who don't really buy into the great market performance that we have had over the past few years, still think that the fundamentals lag the performance of the markets.
So 7IM came out at the beginning of the year with a pretty optimistic view of what was going to happen in 2014. Markets have rattled a bit in January. You change your view?
Not at all. I think our view of the economic fundamentals has been more confirmed than denied. And for that reason, I think we should stick with our strategy, which is that during the course of the year, investors will cease to worry about tapering. They'll cease worrying about monetary policy, and they'll begin to think more and more about the economic growth and focus on that, and that begins to take over as a driver of markets.
Okay. Well, Chris, that's really, really helpful. Thank you for doing that. For those of you who are watching this, the 7IM relationship manager or the regional relationship managers have a full information pack and presentation pack which Chris has put together on what it is that we think is going on. A lot of it is something that you could show to some clients who may be interested, and certainly you may want to see it for yourself. Please call your 7IM relationship manager. Get that information from us. Our views, as stated in the beginning of the year, are intact. World's had a little bit of a wobble. It happens several times a year these days. Stay the course. Thank you very much.